So wrapping up 2022, I was doing my own personal calculations on my investments, my current assets, and my liabilities. So it kind of makes me sad because of how bad 2022 was, but it is what it is, and let's try to make the best out of it.
Is what it is.
So coming into 2023, there might be a few things that will change, like my current investment strategy, because I have a house coming up in the mid of 2023, which will become a huge liability when that happens. And on top of that, the uncertainty of the economy can also be something that is pretty scary as well. So this is why we need to switch things up a little bit for 2023.
Arthur, we're switching things up a bit today.
So when 2023 just started, I did some rebalancing to my portfolio. I closed a position on Genting, which is on the SGX, with some profits, and bought into Capital DC REITs to lower my cost basis because it's ridiculously low right now as compared to my buy price. So in 2022, there were many bad news and FUD that sort of made the whole market go topsy-turvy.
It's a turvy-tapsy world.
And this became a massive problem because people were losing a lot of money, and I personally am sitting on some losses as well. But then it's new year, new me, so 我们不谈伤心事. So something that occurred to me while I was doing that, accounting my net worth, is that my dividends were constantly coming in every single month. And at the end of 2022, I got roughly $590 of dividends from all the stocks and all the ETF that I hold right now, which is pretty amazing. So to give you some perspective, my stocks and ETF portfolio is roughly $27,000, but not all these stocks provide a dividend. So for those that do provide a dividend, it's roughly about $20,000 worth, which gives me about $593 a year. But this put the dividend yield at 3.1%, which is still fairly decent, but accounting for the high interest rate environment right now, this might not be the best strategy or the best yield possible.
But boss, that's not good for business.
And definitely when we go into something new, some people will dissuade you from going with all dividend investing because it's deemed as the older generation or like a boomer like me. But let's be real, if the strategy works for you and people don't pay your bills, their opinion of what you do doesn't really matter.
Doesn't matter. Okay.
And on the other hand, there are also people that do not believe in investing, and that is perfectly fine because they prefer working for money, which you do you, I do me. So in 2023, I'm switching up my investment strategy to focus more on dividend stocks and ETFs because this will give me greater cash flow, which gives me greater financial freedom, and then greater financial freedom equals to less stress in life. And if you're looking to start dividend investing in 2023, there are a few things to look out for when investing in dividend stocks. So the first thing to look out for is the dividend yield. So dividend yield will tell you how much dividends the ETF or the stock will be paying, and it's usually expressed in a percentage. So in my portfolio, I got some SPHD, which pays a dividend yield of roughly 4%. So sometimes your broker will indicate the dividend yield along with the amount of dividends that you receive. So being a newbie like me, when I first started, I picked stocks with super high dividend because it only made sense to me.
Yes.
But I was really wrong, and we'll talk about that in a while. So there are also stocks that will pay really high dividend like Ultra with the ticker MO that pays an 8% annual dividend, which is super crazy right now. And at $45 a share, this means that you'll get roughly $3.76 per year as dividends, which you can do whatever you want with that money. So this money can be reinvested to grow your portfolio, it can be used to pay your bills, or maybe to buy yourself a nice meal at the end of the year. So imagine that if you had 100 shares of MO or Ultra, which amounts to roughly $4,500, you receive $376 a year, which is a lot higher than what I received with my larger initial investment. But then this brings us to the next point, which is payout ratio. So though the dividend yield of the stock can be really high and really exciting, always keep in mind that money has to come from somewhere.
Where'd all that come from?
The sky. It rained money.
So companies do pay out dividends to shareholders, usually from profits that they get for the year. And by paying a dividend is sort of like thanking the shareholders for holding onto their stock and supporting the business. So when a business takes out money from its profit as a dividend, we are able to calculate the payout ratio, which is how much profits is taken out to pay a dividend. So looking back at Ultra, which pays an 8% dividend, we can see that the payout ratio right now is 143%, which doesn't make sense at all. If the payout ratio is 50%, this means the company uses 50% of the profits to pay out in dividends. And if the payout ratio is 70%, this means that 70% of the profit is paid out to shareholders as dividend. So if the payout ratio is 143%, this kind of raises a few questions about Ultra. So this could mean that Ultra might be borrowing money to pay out dividends to investors, which raise a lot of questions about the sustainability of such high dividends.
I borrow some money?
So if the dividend payout isn't sustainable, then this can lead to a dividend cut in the future. And with dividend cuts, this means that the stock price might fall again and you might end up losing your dividends and capital. So right now you must be wondering, so what's a good payout ratio? So this answer will vary from industry to industry, but usually a good payout ratio will be something below 50%. That is something that you can look out for. But for the people that are a little bit more adventurous, you can try exploring higher payout ratios. But do keep in mind that there will be some risk involved with dividend cuts or even capital depreciation. So if you're looking to grow and even build a dividend portfolio but you have no idea where to start, so here's a group of companies for you to consider, which I personally feel is a great starting point for anyone who's looking into dividend investing. And this group of companies is called the Dividend Aristocrats. So Dividend Aristocrats are a group of companies in the S&P 500 index that has paid and increase the base dividend every single year for consecutive 25 years. Which means there is only 64 companies in the US under the S&P 500 that has been constantly giving out dividends every single year and have increased them year on year for the last 25 years, which is more than half of my lifetime. So some of these companies do pay out pretty good dividends like Procter & Gamble or P&G. They pay a dividend of 2.3% annually and they've been paying it and growing it consecutively for a period of 66 years, which is much older than my mom. So just imagine a company is so solid that have been paying dividends and also growing it for such a long time, and there's a whole list of 64 dividend aristocrats for you to pick from, and most of them are probably companies or products that we have heard of like Coca-Cola, Johnson & Johnson, PepsiCo, Kimberly-Clark, and many more. So these are probably some good starting points to consider if you're looking to get started with some of this dividend investing, but there are also options to purchase ETFs, which consists of some of the dividend aristocrats, which might be a lot cheaper to purchase. So if you're still watching this video, you must know that I really love dividends a lot, because to me dividends is one of the easiest ways to get started with passive income. And there are some caveats like needing a long time, having a huge cash flow to purchase these stocks, and much more. But ultimately, I think by starting small, it can allow you to chip away at it, and with small little dividend income, which can then be reinvested to grow that portfolio even more. So looking forward to 2023, I'm really looking forward to grow my current dividend income of $590 to something closer to $1,000, which will mean 100% growth. And that will be really amazing, but it comes at a cost of investing more aggressively, which is something I'll have to plan and strategize. So if you guys are still watching, thank you guys so much. It will be a huge favor if you could drop a like. And you could subscribe if you want to see how my dividend portfolio grows. But last and not least, stay invested, stay safe, and I'll see you in the next one.